On the 9th of May 2014, the biggest merger in the history of advertising was declared dead. Dead before the Publicis and Omnicom mega merger actually saw the light of day. Funeral or breakup, whatever analogy you want to use, the collateral damage from this collapse will undoubtedly be of magnum proportions. So what went wrong? What's the way forward? And who will suffer more from this heartbreak? Tara Kapoor spoke to a host of global analysts to get you just those answers.
Love was in the air when John Wren and Maurice Levy declared to the world 10 months ago that they were soon to walk down the aisle. A merger of equals is what they called it, and it was undoubtedly one of the most anticipated weddings of 2014. Well, maybe just after Brad Pitt and Angelina Jolie.
The name of the new company will be Publicis Omnicom Group, and the split of ownership will be roughly 50-50.
But alas, as the popular saying goes, only fools rush in. And while opposites attract, it takes a lot more than sheer attraction to cement a relationship of such power couples. And before we could even hear wedding bells ring, both bride and groom parted ways, citing irreconcilable differences.
These two companies should, on paper, have made the perfect merger. They're both roughly the same size, they're both in the same business, so there are cost savings of about $500 million a year. And the chief executives saw eye to eye, they drew this whole thing up. But what they didn't do is think through the people issues. Who's going to take what job? What will the clients think? What will regulators think? And what will the taxman think? And on those grounds, the deal eventually fell apart.
And like most messy breakups, the boomerang effect of this relationship going sour is colossal. The markets, as expected, did not take to this news kindly. In fact, both Omnicom and Publicis stock prices have been seeing a steady decline ever since February, when the rumors of this split first hit the streets. Shares of Omnicom tumbled 10% from a February high of $76.5, while Publicis took an even bigger hit with a free fall of 12% from its $23.5 peak in February. The question that remains, however, is whether this is a simple knee-jerk reaction or whether this depression is for real.
I worry in terms of the short-term outlook for the share price of Publicis, because I do think people will be anticipating they will want to make another acquisition. I think Omnicom, in contrast, will go back to buying its own shares. And this is an environment where people will think about the sector writ large, and I suspect the WPP will come into the frame as people will say, look, it's not after M&A, but actually it's in a very good position to make a lot of money.
In terms of financial implications as a result of the attempted merger, by the end of 2013, Omnicom had spent over $41 million in pre-tax charges related to the deal, and another $7 million in the first quarter of 2014. Publicis doled out $52 million on merger-related expenses last year, but has not given out any detailed expenditures this year. The only real plus point for both parties is that with the breakup being amicable, there will be no $500 million termination fee incurred by either company. Besides the financial implications for both holding companies, the losses mount up even more in terms of actual loss of business. In April 2014, Vodafone moved its $1 billion global media account from Omnicom to WPP. Danone's $80 million was split between Havas Media, Omnicom and WPP, but was looking to consolidate its media business under one roof. So it split Omnicom's share between WPP and Havas. So that's where Omnicom's client loss stands as of now. As for Publicis, Microsoft's $1 billion business was split between WPP, IPG, Publicis and Dentsu, and in its attempt to consolidate, took WPP and Publicis out of the picture. According to Nielsen, about $540 million of Microsoft's media business belonged to Publicis' Razorfish. And this was one of the few cases where WPP also lost out. Publicis also lost its portion of GSK's $1.3 billion business to both Omnicom and WPP, where the pharma major decided to consolidate its business in September last year. So that's how things stack up for Publicis. As for WPP, besides the loss of its Microsoft business, WPP seems to have gained quite significantly from the Publicis Omnicom debacle. The biggest test will be Samsung. Samsung spends more on advertising and marketing than any other brand in the world. A whopping $14 billion worldwide in 2013. Samsung is currently a Publicis client and will be deciding where it's putting its bucks in the next 3 months. And the loss of that account would spell disaster for Publicis.
There is no question that the competitors will start to call both some of the talent inside Omnicom and Publicis and certainly call their clients, particularly where there are new conflict situations, and try to take them away.
What's interesting to note, however, is that Publicis is likely to suffer a much more severe blow as compared to Omnicom. Brian Weiser, senior research analyst at Pivotal Research Group, is of the opinion that IPG and WPP will emerge as the biggest gainers out of this cancelled transaction. For IPG, this fallout will ensure more potential suitors that could lead to a competitive bidding process. As for WPP, the stability and security of returning to the undisputed #1 spot will only further escalate its position. On the other hand, for Omnicom, the situation will be more or less neutral as they will fast recover and go back to doing business as usual, neither posing as buyer or seller. All its eyes will be trained on getting capital returns through buybacks.
And if one anticipates where do both companies go now, I think for Omnicom there's likely to be a return to buying their own stock to support their share price, and I think we could see another $6 on the share price in the months ahead. Publicis, I think, is in a much more difficult position because, in a sense, they've opened the door and they said, look, guys, we need a deal to become a bigger, better company. And I think that people will argue that they are likely to remain on the acquisition trail, and that will cast a shadow over the company.
Publicis comes out as the real victim, as it still seems to be in buying mode rather than selling. The French communications conglomerate may well reopen conversations with IPG, and given the fact that it's in a pressing hurry to scale up its operations, it may run the risk of coughing up more moolah than required, given its desperation. What the scenario does do, however, is make WPP very comfortable in its #1 spot.